Bond yields peaked at this point? Where are we headed?
Look, it's quite possible they've peaked. I don't want to make that call just yet because they could slip a little bit higher. But I think in the period ahead, we're probably going to see more evidence that US inflation has peaked. It's probably still going to be too high for the Fed's comfort, so that probably means a 0.75% hike at the next meeting, but that's largely factored in. And I think as the year goes by, we'll see more evidence that's the combination of improving supply, declining delivery times, declining upstream price pressures and so on, combined with slowing demand, will allow bond yields to stabilise and start to head back down again. And if we go into another leg down in share markets, it's more likely to be led by not the valuation pressure of bond yields rising from low levels, but concerns about recession. And again, I think if those concerns about recession are dominant, that would probably see bonds rally. So it's quite possible we've gone from an era or a 6-month window where bonds were a very poor diversifier in a portfolio to where they will be a better diversifier going forward.
Is that why we're seeing so much uncertainty in the equity space? We continue to see outflows from U.S. markets, not to mention European equities as well. Is that concern about recession what's being the big hit for these equity markets?
I think so. Markets are surprisingly resilient, and there are technical reasons for that. Markets hit a oversold level last week. We also had sentiment levels at very negative levels, and that was obviously positive from a contrarian point of view. But then by the same token, markets never go in a straight line. And despite that resilience, I think the risks are still on the downside. And the big driver of that risk is recession risk. Obviously, that recession risk is much higher in Europe. I'd put the risk of recession in Europe at 80%, 70, 80%. In the US, it's probably 50-50. But that, I think, is going to become the dominant concern. And obviously, that impacts earnings expectations going forward.
Well, we do have a lot of data coming out of China this week, industrial production, retail sales. China, of course, staying strongly committed to this policy of zero COVID. So what's your outlook for China, particularly the growth story in this environment?
Well, you'd have to say it's messy. I think the growth target for this year was north of 5%. They're not going to achieve that, obviously. Zero COVID is a big factor behind that. The drought is certainly, and the hot weather is certainly not helping, as is the property slump. The data that we get, I think, on Friday this week will probably show some stabilisation in things like industrial production and retail sales, but it's going to be stabilising at a pretty soft level. And recently we've seen an increase in the number of cities going into lockdowns again, which will act as a drag as we go through September. So you'd have to say that China's outlook remains fairly rough until we get some more clarity on this, probably post the Congress or which I think is coming up in October, November. We might get some change in direction in China and maybe some relaxation on the zero COVID front. But until we get to that point, I think the risk is still on the downside in terms of growth as the government focuses on keeping COVID numbers down. And that obviously has an impact on the economy.
Yeah, you anticipated my next question there. I was wondering if you think investing conditions are going to change materially after that People's Congress happens. Does this present an opportunity for some reforms, some reset of policy?
I think it certainly does. If Xi Jinping is confirmed in his quest for another term and an expansion is his role, then I think he can relax on some of these other things, and that may see some relaxation in the zero COVID policies. And that may also combine with the introduction of mRNA vaccines into China. So obviously a fair way to go on that front, but I think that is probably one thing that we'll see some sort of turning point. The rest of the world has gone down the path of living with COVID, and I think it's only a matter of time before China does as well, but they're unlikely to do that before those political events later in the year.
Shane, of course, an economy that's very much dependent on what happens in China is Australia itself. And we have seen property prices here in the U.S., for example, the sector really taking a hit with the Fed rate hikes. What are you seeing in Australia right now? And do you see any opportunities in the property sector going forward?
Well, there will be opportunities, but it's probably a bit too early just yet. Australia, like many other countries, have benefited massively, or the Australian property market rather has benefited massively from the shift from very high interest rates, say 30 years ago, to the ultra low interest rates we had a year or two ago, and that's now reversing. this rise in interest rates is effectively pulling the rug out from under the property market. And that has further to go because the central bank here, a bit more dovish perhaps than other central banks, but by the same token, it is signalling more rate hikes ahead, and that's going to be an ongoing drag in the property market. So far, property prices in Australia have fallen about 4%, but top to bottom, we think they'll probably fall 15 to 20%. So you've still got a fair way to go. Yes, that will provide opportunities for investors, but it's probably a bit too early to go hunting for those investors unless you're really prepared to dig down into those parts of the property market that have already been hit very hard. But on average, I think it's still a bit too early.